Good morning, everyone, and a warm welcome to the M&G Equity webinar. My name is Rochelle Jagger, and today I'm joined by my colleague Ross Biggs, the Head of Equity at M&G Investments Southern Africa. A very big thank you to all of you who submitted questions during the registration period. It certainly helped us to put together some of the slides for today's conversation. Judging by the number of questions we received, there's certainly quite a bit of interest in the future prospects of the SA-listed equity market. Our aim really today is to unpack why we believe that there are still attractive returns on offer in the SA-listed equity market going forward. If you still wish to submit any burning questions, please do so via the live Q&A chat box that will be available throughout today's session. CPD points will also be available, so please do stick around until the very end. Ross, before we get into the meat of the discussion and the presentation today, I'd maybe like to first touch on the performance of the M&G equity funds over time. The M&G equity team have delivered meaningful outcomes for investors over the last 20 years. The chart we are showing on screen show the two funds that the team manages. The M&G Equity Fund and the M&G Dividend Maximizer funds over the last 20 years are ranked first and third in the ASISA General Equity category over time. You've outperformed the sector average handsomely over time by around 3.5%. But more so, you've also managed to outperform the index. In this case, we're showing the FTSE JSE SWIX index, which has delivered 14.2% on an annual basis over the last 20 years. The M&G Equity Fund has delivered 16.5%, and the Dividend Maximizer Fund has delivered 15.8%. So an extremely good outcome over time. Ross, what do you believe has been your competitive edge in managing these portfolios? You seem to have done extremely well over time.
Yeah, thank you, Rochelle. So, I think, the one thing that sort of stands out to me from this chart is just the power of consistency and compounding. So, if you look at these returns, a couple of percent per year extra doesn't seem like a lot, but, compounded over 20 years, it actually results in a meaningfully better outcome for clients. And you can just see what we've done is we said, assume you've invested 100 Rand at the beginning of 2003 in these various funds. How much money do you sit with at the end of the period? And you can see an investment in the average general equity unit trust, you'd be left with just over 1,000 Rand today. The FTSE All Share Index just under 1,500 Rand, and then investment in the M&G Dividend Maximizer Fund, you'd have just under 2,000 Rand, and in the M&G Equity Fund, over 2,000 Rand. So that's a meaningful difference. You've an investment in the M&G Equity Fund has almost doubled in value compared to the average of the general equity unit trusts. So I think the one most important thing that we focus on is consistency. I think that's been over time our competitive edge. And there's three sort of components to how we achieve consistency. The first component, I think, which is critical, is to have a strong and solid base in terms of the philosophy that you have. So we've had the same consistent philosophy at M&G over the last 25 to 30 years. So I think that's critical, and also continually improving process. So the process, the nuts and bolts of our process has remained the same, but we continually trying to enhance and improve on that process. The market doesn't stand still. We need to continually see how we can do things better and enhance that process. The second part of achieving consistent returns, and this I think is a very underrated part of portfolio management, but it's sound risk management. So when we construct portfolios, we're always very cognizant about the risks that we're taking in the portfolios. Are we balancing the risks in the portfolios? What if we get something wrong? As much as people feel convicted about a stock idea, you can always be wrong. And so what's critical to how we construct portfolios is to have risk limits. We put risk limits in place, and that protects the downside to our portfolios. So I think some people sometimes criticize M&G because they say, well, that those risk management techniques potentially lead you towards more benchmark hugging type returns. And I think exactly the opposite is true. The risk management techniques that we have, in fact, help you to consistently outperform both the benchmark and the index, and deliver benchmark and index beating returns over time. So I think risk management is critical to consistent returns. And then I think the third part of the sort of consistency equation is a strong and stable team. So if you look at the two funds that we had on the previous chart, the M&G Dividend Maximizer Fund, I've been managing or co-managing that fund for the last 20 years. My colleague Chris Wood has been managing the M&G Equity Fund also for the last 17 years. So that strong and stable team, I think, is critical to good investment outcomes. We spend a lot of time mentoring our team, and we want good people coming up all the time. So I think that's a critical component to consistent returns. Yeah, so I think if you can consistently apply these principles, over time, the principles of a strong philosophy, sound risk management, and a strong and stable team, you can actually generate consistent outperformance over various time periods. If you just look at the M&G Equity Fund, you can see this is the performance of the fund relative to the general equity unit trusts. And you can see there we divided this into quartiles, and over all periods, the M&G Equity Fund has been in the top quartile. If you look at the M&G Dividend Maximizer Fund, you can see a similar story where performance has been consistently in the top quartile. And maybe just on a separate point, when we look at stocks and companies and investment ideas, our focus tends to be on the sort of 3 to 5 year time horizon. What we found in the stock market is that we're getting a lot more funds, especially with algorithmic trading, with AI funds. We're seeing a lot more funds focusing on the short term, and so our investment time horizon, we think you can actually make more money given how short-term focused the market is by focusing on the long term. And so what is critically important for us is that 3 and 5 year performance. Less so the 1 year, more focus on the 3 to 5 years. Maybe just sort of talking or coming back to that point on risk management and having many different ideas in the portfolios, I think one very important thing is to have a very diverse portfolio. So we've just taken the Dividend Maximizer funds contributors to relative returns over the last 12 months. So these have been our outperformers over the last 12 months. We've divided the stock ideas into sectors, or consolidated them into sectors. And what you can see is the contribution to outperformance in the fund has come from various different sectors. So this is typically what we want to see. We don't want to see one sector, one stock idea contributing all of the outperformance. We want to see that outperformance coming from various different sectors, because that means we're applying the risk management principles soundly.
Thanks, Russ. That's certainly quite a compelling story. And later on in the presentation, we'll dig into some of the individual stock ideas that you currently have. If we look at that long-term picture that we showed, certainly South African equities have done very well over the long term. But the short-term picture has not been as rosy. Returns have pretty much disappointed relative to the long-term outcomes. Quite clearly we've got structural issues in South Africa. If we look at economic growth, that's been fairly pedestrian over the last couple of years. Even if you look at some of the forward-looking metrics, we've got the IMF, indicating that SA would only grow 1.2% in 2023. And I guess my question to you is, do we necessarily need the South African economy to do well for the South African stock market to do well?
Yeah, I mean, I think that's a sort of a common fallacy. I think it's a fallacy to think that by being able to predict economic returns, that you can predict stock market returns. So, first of all, it's very difficult to predict the future. I think, economists like to try to predict what might or might not happen. Half of the time they're right, half of the time they're wrong. So I think that's the first thing I would point at, is it's very difficult to predict the future. You never know when COVID's going to come along. And the second part of that fallacy is that predicting economic returns is not necessarily going to mean that you can predict stock market returns. And we've done a study, and there are many different types of these types of studies. But we've done a study to look at the stock market returns relative to the sort of GDP forecast for the next year. And you can see on this chart, on the x-axis, that's the SA GDP for a calendar year against the performance of the South African stock market over that year. And what you can see from this chart is it's basically it's noise. It's random. You can see years here where GDP was running hot at 8%, and you still had negative stock market returns. You can see years here also where GDP was running at minus levels. So clearly in recession, and yet you had some of the better stock market returns that you've seen. So, I think this just is further evidence that actually, it can be very entertaining talking about, what's going to happen in the economy and to politics, but actually it doesn't help you predict or ascertain stock market returns. The one other sort of important thing to also understand is that the stock market is not the South African economy. So, if you look at the South African stock market and you look at the companies on the market and look at the revenues that they generate, in fact, just more than 1/3 of revenues come from South Africa. So, it's you can see from this chart, we just, you look at this pie chart, you can see 1/3 coming from Europe, 1/3 coming, or 44% coming from Asia Pacific, China being the biggest contributor to that component. So, if you want to know what's happening, or if you want to talk about what's going to happen to the South African stock market, you're probably better off talking about what's going to happen to the Chinese market. And so, it's a fallacy to think that by focusing on the South African economics, you can actually, forecast what's going to happen to the South African stock market.
Thanks, Ross. That's quite an interesting breakdown. I'd like to maybe turn to why you are still very positive on the return prospects for SA equities. Now, we know in the short term that markets are driven by investor sentiment, but over the long term, what really matters are earnings. And if you just think about the backdrop that we find ourselves in, there's still talk of a hard landing, a possible looming recession. We've had aggressive interest rate increases across the globe. If you were to say contrast South Africa to global markets, what does that landscape look in terms of earnings as well as valuations? And where are you seeing the most risk and sort of opportunity? And I think this is a particularly relevant question, just given the changes in regulation with respect to offshore allowances, and also just given that the SA equity market has underperformed relative to global markets over the last couple of years. So I think, what are your thoughts on valuations and earnings?
Thank you, Rashil. I think your last 2 points on valuations and earnings, I think those are the critical drivers of stock market returns. So, whenever someone says to me, what do you think, how do you think this company is going to do? What do you think about the stock market? the two things I think of first are, one, what is the valuation of that company or that country, and then what is the sort of earnings power and cash flow generation engine of that company or country look like. I think those are the two most important drivers of returns. What we've done here is we've put together charts showing the earnings power of the JSE going back over 60 years. And in blue here, you can see the earnings of the JSE, and in green, you can see the price of the JSE. And I suppose the one thing that stands out from this chart is that price follows earnings. So as earnings move up, so the price of the JSE follows them. The price of the JSE is often a lot more volatile than the underlying earnings, but over time, earnings follow price. And so, if you look back at South Africa's history over the last 60 years, there's been plenty to worry about. There's been, economic upheavals, political upheavals, plenty to worry about over the short, over the medium, over the long term. But despite that, you've actually had a fantastic performance from the JSE. So, this chart we've done in dollars. So we've included here the rand depreciation on effect on returns, and you can see over this period the JSE has returned 10.6% per annum in US dollars, and I think that's a pretty phenomenal return. It's one of the better performing markets globally over this period. If you compare that to the S&P 500, the S&P 500's performed about 10% in dollars per year. So, the JSE, contrary to what a lot of people think, and despite the sort of weakening rand of this period, has actually outperformed the S&P 500 over this period.
Yeah. Ross, what's quite interesting is if you look at since the GFC, 2008, 2009, my observation there is that the price and earnings have pretty much gone sideways. Is that a uniquely South African story?
Yeah, so that's a good question, and if we look at yeah, exactly. If we go sort of focus in on that shorter period on that chart, this chart basically shows you the earnings of the JSE over the last sort of 25 years. You can see that chart or that graph is in the dark green. So basically, since we had a nice run up in earnings from the sort of 01-02 period up to the GFC, as we saw the strong boom from the Chinese commodity cycle, and then from 08-09, basically earnings have been flat, and the JSE has gone sideways since then. But that's no different to what we've seen in the rest of the world. So if we look at the rest of the world, excluding the US, you can see, the experience in the rest of the world has been very similar to the experience that an investor has had in South Africa. So, in dark green here is the MSCI All Country World Index, excluding the US earnings and price, and you can see also since basically since the GFC, earnings have been flat in the rest of the world, excluding the US. So, as much as people like to make up stories about, the economic and political situation in South Africa, our experience in the market here has been very similar to what most countries in the rest of the world have experienced. The standout market for the last sort of 10 years since the GFC has been the US market. And you can see, the US market actually had a pretty pedestrian experience, in the sort of late 90s, early 2000s, where earnings actually didn't really go anywhere for a long period of time. But then post the GFC, you can see how that earnings base has gone from sort of, call it 150 up to, almost 500, 600. So your earnings base in the US has gone up multiple times since the GFC. So that's been the market to have been invested in for the last 10 years. But the question now is, do you still want to be invested in the US market? It's obviously become a very large component of the All Country World Index. And I would say, given how much those earnings have gone up in the US, you need to be slightly careful. You can see on this chart here that in the last year, those earnings have started to dip down. So I would say you've got to be a little bit careful, given how high profit margins have got certainly over the last couple of years in the US. So that's the sort of that that we've looked at the earnings power of these markets. The second important question then is, well, what does the valuations look like? And I think that's also where you need to be a little bit careful about the US, because if we go and look at the price to book multiple of the US market, you can see how elevated that price to book multiple is where we sit. And so we've got potentially high earnings in the US and a high multiple. So that multiple of price to book since the GFC has gone from about 2 times price to book in the US to almost 4 times price to book. And a year ago it was in excess of 4 times price to book. So the valuations look potentially as steamy as they were in sort of the IT bubble in the late 90s. If we then go look at the rest of the world, you can see you can see the rest of the world looks fairly valued. So that's the light blue chart there. So trading on 2.7 times price to book, it looks fairly valued, I suppose, compared to history. But obviously we've got the expensive US market sitting in that index. So if you exclude the US market, you can see in dark blue there's the all country world index excluding the US, and that looks quite attractive relative to history. If we then sort of move forward to say, well, how does South Africa compare to global markets? You can see South Africa looks relatively attractive. So we're only trading on a 1.8 times price to book. Traditionally the South African market is traded in excess of 2 times price to book. So if you go back to sort of 2013, 2014, 2015, you can see the South African market actually traded more expensive than global markets. Come forward a couple of years to sort of 2020 or the COVID period, you can see there was a big rush into defensiveness and quality. And so what we saw was global markets starting to re-rate while the South African market derated. And so, a gap started to open up between global markets and the South African market. So I think, we're cognizant that actually, the US market's expensive. We think the US market's expensive, and the South African market, we think, together with quite a few markets ex the US, also look particularly attractive. So one of the big markets in MSCI All Country World Index, excluding the US, is Japan, and we also like the Japanese market, for instance.
Thanks, Russ. It certainly looks like quite a bit of bad news priced into the South African market over there. Just in terms of your portfolios at the moment, I mean, the 2 funds we mentioned earlier, the M&G Equity and Dividend Maximizer funds, both of them can invest offshore. How are you implementing these, just given these views on valuations and earnings? How much exposure to the offshore market do you have, and how actively do you manage that exposure?
Yeah, so that exposure, I suppose the core focus, when we're evaluating what type of exposure to have in offshore markets versus local markets, is to understand, firstly, the valuation of the South African market relative to offshore markets. And so, if we go back to the 13, 14, 15, 16 period where the South African market was more expensive than global markets on a price to book basis, there it made sense actually to have a much higher weighting to offshore markets. So, during that period, we actually had our maximum offshore allowance allocated to global markets. Then if you move to the sort of COVID period, you can see what we did is we actually moved a substantial amount of our offshore allocation back to South Africa. And that's because the South African market started to trade at a substantial discount on a price to book basis to global markets. So, we have been fairly aggressive in terms of managing that offshore weighting in our Dividend Maximizer fund and in the M&G Equity fund. And you can see, we sort of during COVID and for the next year after that, sort of aggressively reduced that offshore allocation down to sort of 20% because of that valuation gap that opened up.
Yeah, thanks, Russ. That certainly shows your preference for the South African market relative to global markets. Maybe if we can move on to your portfolio currently as it stands, and to maybe interrogate some of the top sort of best ideas in your portfolio. On the screen we've got the top ideas, and we've grouped them by certain categories. So we've got industrial rand hedges, we've got the resources sector, industrials, the general industrials, and financials being made up mostly by the banks. And I'd like to maybe first touch on shares such as Richemont and Textainer. Richemont is, of course, a luxury goods company. Textainer is a global shipping company. I guess if you were to characterize these companies, they are effectively global cyclical companies. Just given the backdrop we chatted about earlier, a potential recession, add to that also China has been slowing and will slow during 2023. What do you still see in these companies, and why do you hold them as top positions in your portfolios?
Yeah, that's a good question. So, when we generally look for stock ideas, we're cognizant that, most of the time the stock market gets it right. So when we look across the stock market, the bulk of stocks are fairly priced. Where we focus our attention on is where do we think the market's getting it wrong. So, we're looking for companies where, the market's overly optimistic about the prospects for growth in the company, or where the market's overly pessimistic, about a company. So, is the market getting too excited and overestimating cash flows going forward, or is it getting too pessimistic and underestimating cash flows? So that's where our focus is. And a company like Richemont, we during COVID, it got down to very depressed valuation levels. So there we thought the market was, thought that the business would generate poor cash flows into perpetuity. And so, during COVID and last year we saw as well, where the market got overly worried about a recession, overly worried about a Chinese slowdown, there also the valuation of Richemont came down quite a bit. Because the market tends to focus on the short term. Our focus is on, what is the cash flow going to do? What's it going to look like in the next 5 or 10 years' time? So if we go look specifically at Richemont, we think it's a very high quality company. It's got some fantastic brands. You can see on this chart here, we've got 2 of their best-selling products, the Cartier Love Bracelet and the Trinity Ring. The Trinity Ring, that came to market first in 1924. So, we're coming up to the 100th anniversary of that ring, and it's still as popular as it was 100 years ago, and the same for the Cartier Love Bracelet. So, we think this is a very high quality company, good brands. They did get into a bit of trouble in the sort of 2013, 2014 period. You can see the dividends from this business, which is the chart in red there. Those remain flat for a couple of years. Cartier watches, for instance, were often used as bribes for Chinese officials. And in sort of 2013, 2014, when the Chinese government clamped down on corruption, Richemont had to restructure that watch business, and so dividends remained flat for a couple of years. But actually, this is a very, very good cash flow generative and growing business. And so when COVID came along, we used the opportunity of that depressed valuation, to start to accumulate a position in Richemont. And again, when we had the fears around the Chinese slowdown. So, when we look at Richemont and we say, what is the cash flow going to look like in 5 years or 10 years' time? We think it's going to be substantially higher than where it is today. So that dividend that we see on the chart there, we see that going up substantially over the next couple of years. So we think, this is a high quality company trading at a pretty attractive valuation. If we move to Textainer, so they let me maybe explain first what Textainer does. It's the second largest shipping container leasing company in the world. So you can see there on the bottom of the chart is the types of containers that they lease out, this is a very well managed company. It's listed both in the US and in South Africa. It's a fantastic high quality company. It's got very good competitive advantage. And the reason we like Textainer is we think the capital allocation in this business has got better and better. So if we just look to the next chart, which shows you the return on equity of the business, and then in black we've got the price to book. You can see over time this business has generated a return on equity in excess of 15%, but they did go through a bit of a tough period in 2017, 2018. One of their large customers went bankrupt, but you can see that return on equity is recovering pretty quickly. They're now generating close to 20% return on equity, and that return on equity we think for the next 5 years should remain at a fairly good level, above 15%. Having said that, though, you can see the valuation of the business we think looks particularly depressed. The business is trading on about a 0.75 times price to book. And I mean, we think that this business should probably trade closer to 1.5 times price to book multiple. So that means, potentially there's 100% upside to the valuation of this business. The one interesting thing is the capital allocation of this business we think has got better and better. We've had new management in place for a couple of years now, and they took the opportunity of these very low valuations to buy back 25% of the company. So we think returns should be much better going forward. Taking advantage of the market's concerns about recession, the effect that it might have on shipping, and we think the valuation looks very good.
Great, thanks, Russ. Maybe let's touch on the resources sector, always very topical in the South African context. I mean, if you look at the earnings and the returns from resource companies over the last 5 years, it's been really good. I mean, I think the resources sector has returned in excess of 20% per annum over the last 5 years. But if you look at many of the companies, they trade at fairly elevated levels of earnings, and many of them have been making super profits. You have about 25% of your portfolio invested in the resources sector. Are you not maybe concerned about where earnings are at the moment? They seem to be at peak levels.
Yeah. I think when you look at the resources sector, you always need to understand where you are in the cycle. I think that's critical to understanding, an investment in the resources sector. And what we've got on this chart is to show you, in green we've just got the earnings of the South African market, and in purple the earnings coming from the resources sector. So you can see, those earnings there in purple over the last 2 years have been clearly elevated. So we've been at the top of the cycle in terms of the commodity cycle. So you can see going back to sort of 2007-8, there, we also had a very strong resource commodity cycle driven by the Chinese economy. You can see 2016, 2017, there we went through a big dip. So I think what we can say about the resources sector at the moment is that margins are elevated and earnings levels are elevated. The most important question, though, is what is priced into the equities of resource companies. So how is the equity valued? So if we go look at Anglo American, and I've just used Anglo American here as a nice example because we've got some nice history. But you can see this chart just shows you the operating margin in green for Anglo American. And also what clearly stands out here is that operating margins are at elevated levels at the moment. So Anglo American earnings sort of close on 40% operating margin, higher than what it earned in the Chinese commodity boom. So clearly margins are very high. But if we go look at valuation and you look at the purple chart there, the price to book of Anglo American, which we think is a good measure of for cyclical companies, you can see there the price to book at the moment is sitting, round about where Anglo American is traded over time. So that's sort of 1.5 times price to book multiple. So I think what is clear to us is that the market is not making the same mistake that it made in 2008 and 2009, where it put those very high earnings and margins on very high multiples. Today, the market's, maybe it's learned from its lessons in 07, 08, and it's putting these companies that's saying, actually, these margins are very high, they can come down, and therefore putting it on a much lower multiple. So we don't have a big quarrel with the market in terms of how we would, value Anglo American today.
Sure. Thanks, Russ. Yeah, I guess it would be remiss of me not to ask you a question about Eskom and the energy crisis that we find ourselves in. I mean, I know we talked about earlier the SA market being global in nature, but, like it or not, there are South African companies exposed to the SA economy and the SA consumer. We just recently saw, Pick n Pay coming out saying that they've been spending 350 million rand over the last 10 months on diesel. We've seen similar reports from ShopRite. If you look to the mining space, Impala had lower volumes due to load shedding. How do you navigate this sort of risk in terms of your portfolios, and what are you looking for? And are there any opportunities that have come out of this crisis?
Yeah, so I think, going back to, how we evaluate potential investment returns, we go back to our basics. So we again say, what is the valuation of the companies look like? What does the valuation of the JSE look like? And then, how do we think these issues like Eskom, like Transnet, the generator issues, how do we think that's going to affect the future cash flows of these businesses? So we look at, 5 years, 10 years, what are the cash flows going to look like, given that we've got these issues with Eskom and Transnet? And, these issues affect different companies differently. What we tend to find is that, the strong companies are going to start to take market share away from the weaker companies. So in this type of environment, a company with a strong balance sheet with plenty of cash reserves can actually, in a sense, take advantage, or it's got the optionality to take advantage or mitigate these risks. And so, I think what we see over the next 5 years in South Africa is that the strong companies are going to potentially get stronger, and the weak companies get weaker. And so, when we're looking for investment ideas, we're saying what companies potentially actually can navigate this very difficult period best. And what you might find is in 5 or 10 years' time, these companies, have taken a lot more market share away from some of the weaker companies. One of the sort of companies we've invested in, which is in our minds clearly taking advantage or mitigating these risks, is Omnia. So Omnia we'd regard it as a sort of a globally competitive fertilizer and explosives business. So selling fertilizer into the farming community in sub-Saharan Africa, selling explosives into sub-Saharan Africa and globally. They've got a very strong balance sheet. They're in a net cash position, and so they can think about investing in solar projects, investing in water treatment plants, and that's gonna protect the business going forward. So they're looking at different options and how they can protect the downside. And so companies like this, where the market's so worried about how Eskom and Transnet is going to affect them, we see valuations being particularly attractive. So Omnia on our sort of numbers is trading on a 7 times earnings multiple, which we think is very, very attractive for this type of globally competitive business. It's one of the sort of companies, again, in our portfolio, we think could double. This company probably should be on double the rating that it is. And they're going further. So we've looked at solar and water. They're now looking at how can they get themselves even better optionality with the ammonia that they purchase. So they purchase ammonia from Sasol. They purchase ammonia from places like Qatar, and they rail it in using their own rail wagons from Richards Bay to Sasolburg. They're now looking at how can we produce green ammonia in Sasolburg to give us even further optionality. So we think this is a fantastic company with a lot of upside.
Great, thanks, Russ. Certainly a few interesting ideas there in your portfolio. Before we move to some of the Q&A that we've been receiving throughout today's session, we have covered quite a bit today. What are sort of the key takeaways for you if you would leave our audience with a sort of final message?
Yeah, so I think maybe three takeaways. The first is that we think the South African market overall looks pretty attractive, despite concerns around Eskom, Transnet. It definitely is going to affect cash flows going forward. But the critical thing is to decide is it going to be a slight dip, or is it going to be a permanent decline in cash flows? But yeah, we think the South African market looks pretty attractive. The second point is that within the South African market, we're finding a lot of very high quality companies which are attractively priced. Companies like Textainer, like Omnia. So we're finding plenty of opportunities in the market to make alpha for our clients. And then the third point, I think maybe just coming back to the sort of the introduction and what we discussed up front is a robust philosophy and process, and continually improving your process together with sound risk management, can produce outsized returns. So we see risk management as the framework to produce consistently good returns which outperform the benchmark.
Thanks, Russ. Thank you for your time in the discussion today. We'll now take some of the questions from the audience.